The active trading session on Wall Street presents a fascinating setup for hardware investors, with Micron Technology Inc. trading at a live intraday price of $76.10, marking a strong upward surge of 4.11% as massive institutional trading volume pours into the semiconductor sector. While most retail traders are staring blankly at the headline numbers and celebrating this green session, the real narrative is unfolding behind the scenes in the options market, in order books, where larger funds are placing multi-million-dollar bets. The general consensus across popular online investing circles points to this rally as a standard cyclical recovery, but the underlying data shows a structural divergence that traditional retail investors are completely missing. To truly understand why the data center architecture is shifting, you have to look beyond simple pricing and dissect how physical server limitations are reshaping equity valuations. When you look at popular trading communities or browse individual brokerage portfolios, the standard belief is that memory chips are just basic commodities that follow a predictable boom and bust schedule. The classic retail expectation says that when supply is tight, companies make a premium, and when factories overproduce, margins collapse into nothingness. But the current reality is completely shattering that expectation because high-bandwidth memory architecture is no longer behaving like a traditional commodity. Big institutional platforms are heavily acquiring positions because they realize that modern artificial intelligence computing clusters are facing a massive hardware bottleneck that cannot be solved by simply adding faster processors. A graphics card can run billions of operations per second, but if the local storage subsystem cannot feed instructions to that chip at a matching velocity, the entire server sits idle, burning electricity without processing data. This structural reality has flipped the hardware trade upside down, making memory capacity the absolute premium element in advanced enterprise hardware design. If you observe standard retail portfolios on popular retail investing sites, or look at how self-investing accounts are allocating capital, there is a clear bias toward high-profile silicon design houses. People love to talk about how a dominant software platform or a specialized chip designer will capture all the economic rent in this technology expansion. That is the common narrative keeping everyone comfortable. However, the contrarian perspective that sophisticated wealth management teams are looking at tells a completely different story. Every single cutting-edge server rack being built for deep learning models requires exponentially more high-bandwidth memory than old enterprise hardware systems. We are talking about a physical footprint increase that completely alters corporate gross margins across the sector. This means that while traditional client computing and standard desktop sales remain flat or boring, the high-performance data center business is essentially subsidizing a massive corporate financial expansion. This is the precise tension between investor expectation and financial reality that keeps modern video viewers locked into deep financial analysis. Let us break down the recent market action that has driven the daily swings and massive volume spikes we're seeing this week. Micron has experienced intense volatility over the last several quarters, trading through a wide 52-week range from a low of $90.93 all the way up to an all-time high of $818.67 before establishing its current baseline in the mid-700s. This afternoon, as nearly 42 million shares change hands, institutional desks are actively rotating funds out of extended consumer internet software positions and moving directly into infrastructure hardware. This massive volume represents a significant institutional accumulation phase that often precedes major index reweighting events. Traditional market participants using basic individual brokerage accounts often fail to track these block trades, but when you analyze order flow across advanced platforms like Interactive Brokers, you clearly see that large-scale block purchases are outpacing retail sell orders by a massive margin. This institutional activity is a direct reaction to recent earnings reports, where executive management confirmed that their entire high-bandwidth memory production capacity is completely sold out, not just for the current fiscal period, but for the following calendar year as well. This brings us to a critical inflection point regarding sector momentum and macroeconomic pressures. The broader federal monetary tightening cycle and persistent high interest rates have made capital expenditure incredibly expensive for average businesses. Yet when you look at the capital investment guidance from giant hyperscale cloud providers, their spending on infrastructure is completely decoupled from standard macroeconomic trends. They are deploying hundreds of billions into building physical data center hubs because the competitive pressure to establish processing dominance overrides any short-term macro anxiety. This massive corporate spending pipeline acts as a guaranteed revenue backlog for hardware providers who control the physical supply chains. It is exactly why prominent sector names like Nvidia stock, Tesla stock, and Apple stock are constantly being reevaluated based on their capital deployment strategies. The surrounding market conditions have forced a massive rotation where defensive technology hardware is being treated with the same stability that investors historically looked for in utility assets or high-yield consumer staples. At this exact point in the market cycle, it is highly valuable to hear directly from the people managing their own capital. Comment below how many shares of Micron Technology Inc. you currently hold in your portfolio, and let me know if you are using an automated strategy or a traditional individual brokerage account to manage your positions. Getting a clear look at how real participants are navigating these wild daily swings helps map out whether retail sentiment is turning overly euphoric or remaining appropriately cautious. To properly contextualize this current price movement, we need to take a step back and look at what this enterprise actually does from a fundamental operations perspective. Based out of Boise, Idaho, and founded back in 1978, this company stands as the sole major American manufacturer of dynamic random access memory and solid-state storage solutions. They operate through 4 primary business segments: the Compute and Networking Business Unit, the Mobile Business Unit, the Storage Business Unit, and the Embedded Business Unit. Their core technical model relies on designing and fabricating dynamic random access memory components alongside advanced non-volatile flash storage. For decades, this business model was incredibly exposed to standard electronic consumer demand, meaning their balance sheet was directly tied to how many personal computers and mobile devices were sold globally each holiday quarter. When phone sales dipped, their inventory piled up, forcing massive write-downs and painful quarterly losses. That historical legacy is why traditional financial screeners still show a volatile long-term net income history, which often scares away conservative investors who do not look closely at modern structural modifications. However, the transition away from low-margin consumer electronics toward high-value data center architecture has completely altered the structural revenue model. Instead of selling cheap memory modules for consumer laptops, the operational focus is now heavily weighted toward proprietary multi-chip packages in high-performance server components. When you look at old quarterly reports from previous market cycles, the gross margins were notoriously unstable, frequently swinging from positive 40% down to negative numbers within a single calendar year. Today, the operational scale has been completely stabilized by multi-year enterprise supply agreements with major global cloud networks. This means the predictable cash flow allows management to confidently deploy hundreds of billions into long-term capital projects, including massive state-of-the-art domestic manufacturing facilities inside the United States. This expansion represents one of the largest domestic industrial commitments in American history, aiming to secure localized semiconductor manufacturing capability and reduce structural reliance on overseas fabrication foundries. Understanding this operational foundation allows us to map out the future outlook and potential scenarios that could play out over the coming quarters. The first potential catalyst is a massive structural squeeze on legacy memory supply. Because the manufacturing process for advanced high-bandwidth memory chips is incredibly complex and requires significantly more silicon wafers than traditional modules, the industry's total manufacturing output is being naturalized to a lower volume. This means that even if demand for personal computers and smartphones remain completely flat, the global supply of traditional memory chips is going to dry up because factories are shifting their machines to produce high-margin server components. This supply destruction is a hidden opportunity that could drive commodity prices to historic highs, dramatically benefiting the corporate bottom line in ways that traditional economic models completely fail to predict. On the flip side, we must examine the critical risks that could disrupt this bullish trajectory. The primary structural risk is the incredibly high fixed cost base required to run advanced semiconductor fabrication plants. If global macroeconomic growth slows down to a point where hyperscalers are forced to pause their infrastructure expansions, these clean rooms will experience underutilization charges that can wipe out corporate profitability with shocking speed. Furthermore, the memory industry remains exposed to intense international competition from massive South Korean industrial groups who are simultaneously scaling their own high-performance operations. If a massive global production capacity glut occurs late next year, the premium pricing power currently enjoyed by management could evaporate, forcing a severe valuation compression across the entire sector. This expectation of continuous multi-year margin growth would crash hard against a reality of oversupply, creating a dangerous trap for late-stage investors who bought shares at the absolute cyclical peak. When you weigh these competing scenarios against each other, the strategic value of sophisticated investment platforms becomes incredibly apparent. Many independent traders managing their own accounts through basic online investment tools look at a stock chart and try to predict short-term directional movements using simple technical indicators. But managing risk in a highly cyclical, capital-intensive industry requires a much deeper understanding of asset allocation. This is why many sophisticated wealth managers suggest looking into diversified structures like specialized mutual funds or automated allocation platforms like Schwab Intelligent Portfolios to balance out the intense volatility of individual semiconductor holdings. Having a balanced framework allows an investor to capture the massive upside of infrastructure expansion without exposing their entire life savings to the sudden, violent drawdowns that define the hardware production landscape. Looking at the broader landscape of modern trading infrastructure, the way everyday individuals access these complex international corporations has changed dramatically. A few years ago, executing advanced options trades or accumulating international asset exposure required a premium relationship with a high-fee human broker. Today, modern financial platforms like the Robinhood app or the comprehensive SoFi Invest ecosystem have completely democratized access to the global equity markets. Investors can instantly buy fractional shares, write covered options contracts, or deploy automated cash management strategies directly from a mobile interface. Even legacy institutional giants like Fidelity Investments have completely transformed their digital presence, offering zero-fee index products and advanced research suites that rival professional institutional terminals. This rapid expansion of consumer investing sites has created a market environment where retail capital moves with unprecedented speed, amplifying short-term price trends and creating massive liquidity waves that institutional funds actively exploit. As we look toward the final half of the trading year, navigating this complex market requires a firm commitment to objective financial metrics rather than emotional media narratives. The central insight of this entire analysis circles back to the core conflict between what the average investor expects and what the underlying corporate architecture actually dictates. The market expected a standard, temporary cyclical bounce in an ordinary commodity company. The reality is that we are witnessing a permanent structural reassessment of hardware value, driven by an unprecedented physical constraint in infrastructure design. The companies that manufacture the physical storage and transmission systems are capturing a permanent share of enterprise technology budgets, turning old cyclical factory businesses into essential modern infrastructure assets. Whether you manage your wealth through a traditional automated portfolio model or actively execute block trades on an advanced institutional platform, tracking this fundamental shift is the single most important factor in preserving and growing your capital over the next industrial cycle. The premium valuations will not belong to the entities that merely write code, but to the organizations that own the physical, localized industrial capability to build the underlying machine itself.
Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.